Hello, everyone. Thank you very much for being here. We are so happy to have Ray Heimann here, and we're going to hear about a deal which we don't get to hear about every week, so that'll be a lot of fun. And because Ray's coming on, and he's this very adventurous, creative sponsor, I wanted to find a quote that was fitting to him, and I found this one. My father used to say that it's never too late to do anything you wanted to do. And he said, you never know what you can accomplish until you try. That quote is by Michael Jordan. So that's how I see you, Ray, as another Michael Jordan. So I did not look up your, I failed to pull up your biography. So I'll just wing it and tell everybody that Ray has been working with us for a couple of years now. He is a sponsor on multifamily. He and his team go out and find properties that need to be rehabbed. Sometimes they put Section 8 in, sometimes they don't put Section 8 in. The last deal that they just closed on, which we really liked, they put Section 8 in. They're rehabbing the whole place, which is 100 units. And what else could I say about you, Ray?
That is pretty good. I think the Michael Jordan comparison is a pretty one-to-one, especially our game on the court. In fact, that some days I think I might even best him. Um, but we're pretty evenly matched.
Okay,
But
good.
yeah,
So take it away. Tell us about
uh,
what you've got today. We're looking forward to hearing, and you should be able to share the screen.
excellent. I will do that. Well, thank you very much for the intro, Peggy, and very happy to be on here again. And thank you all for your time. I really appreciate it. As Peggy was saying, we've been working with each other for quite some time now. Terra Capital, which is my fund that I operate with my partner, Tom Higgins, is a value add multifamily fund focused specifically on the Midwest and even more so specifically on Columbus, Pittsburgh, and Indianapolis. The deal that we are looking at today is in Indianapolis and is a very strong example of what we're working on. We only do properties that are sub 100 units, so we're focused in the sub-institutional space. That's where we find the greatest opportunity to really take advantage of value add. There are older properties that can really benefit from somewhere between value add and redevelopment, and that's where we live. That is an area that is too big for local mom and pop groups and flippers to participate in regularly, but it's way too small for large or regional developers to play in regularly as well. So we like this niche, and it's something that the two of us have been doing since 2014 together. And we have done it successfully in New York City. We've done it successfully in Pittsburgh, Columbus, and Indianapolis as well. So I will go through this deal at a high level, talk a little bit about Indianapolis as well. It's an extremely interesting market, very exciting, and it's kind of one of those interesting places that isn't on the front page of the news all the time. But if you're a follower of real estate digests, you see it published about quite frequently. And we can go from there and do Q&A. So this property that I'm going to go through today, it's called the Harrison. It is located in Indianapolis. It is pretty similar to what we're generally looking for on returns, is something in the 1.75 to 2.25x LP multiple on invested capital range. In this particular case, we have it at a 22% LP IRR, 3-year hold. It is 84 units. It's 43,000 square feet. We are buying it at a very attractive price of $49,000 per door. That is because the MEPs, plumbing, electric, et cetera, need to be replaced. There are 2 elevators in there that need to be repaired. So there's a lot of value add / redevelopment work that needs to be done. And so the price is very attractive. And we're putting in $90,000 per door. So this is a pretty major pretty major project, but is very much so in our wheelhouse. And in fact, we recently did a deal in Pittsburgh. It was only 64 units, not 84 units, but very similar type of work that is being done there. And the highlights that I would call out here is that this part, Indianapolis in general, is a very interesting MSA that is supply constrained chronically. This particular area of Indianapolis is even more so. It's actually an historic region, the near north side of Indianapolis. So there's very little new development that isn't related to something essential. So the biggest development that has happened there in the last 40 years has all been IU Health. They're actually almost doubling the size of their main HQ campus, which is right in the same neighborhood as this property, over the next few years, and have broken ground on a few of those projects. In fact, some of those buildings are almost done. And so we really like that aspect of it. It's one of the core parts of our thesis, is to target supply constrained areas. This is a very recession resilient market. I'll talk about why that is, but the long and short of it is it was pretty much flat through the 2007, 2008 financial crisis. It's had virtually the exact same mid-single digits population growth since the 80s. And it is really built on a bedrock of healthcare, education, and tech, medium cost location, tech and business services jobs that are last to be laid off. They don't really change that frequently. And if you've ever spent time in the Midwest, which is where I'm from, Indianapolis is like one of the most Midwestern places. It's just the same folks in the same houses for forever and ever, living their very nice little Midwestern lives. And we like that type of market because we know that in a recession or a downturn, those jobs aren't going away, and that the population is going to be very steady over time, which is important. We don't want spiking population where developers are going to come and build a ton of supply to meet that. And when you do that, you get situations like we've seen recently in other parts of the US with declining rents. Instead, we want a chronically supply constrained, low and slow growth market with really recession resilient job indicators. And then finally, a pretty meaningful value add component to this deal. In fact, it is the most important aspect of it. And that is our specialty. And it's where we're able to get good investment profiles like the one you see at the top of the slide by really rolling up our sleeves and putting a lot of work into rehabbing an old building. So real quick, I'm over here on the right-hand side. This is my partner, Tom Higgins, on the left. Tom and I actually met in college, and we've been working together ever since. We actually started investing together while we were in college. Tom has also had a number of roles outside of Terra, as have I, but he worked for the Rose family in New York, and he worked for Alpha Multifamily, which is a national developer. He focused on the Midwest and the Northeast. He has renovated or developed over 2,500 units. He is just best in class for our generation on real estate development, construction, value add, renovation, et cetera. My background is more in acquisition strategy and real estate from a more institutional perspective. I worked at JP Morgan in investment banking. I covered US real estate and REITs there. I then moved on to Booz & Co., where I sat on their acquisition strategy team and did just over $3.5 billion of corporate transactions there. And finally, I worked at Terra Capital, which is a private equity firm in Boston focused on healthcare, tech, and real estate. And I was more focused on real estate, and I did and closed on just over $750 million of transactions there. And so we have been together for just over 10 years now and have done virtually the exact same thesis in New York City, and then the three markets we're focused on now: Columbus, Pittsburgh, and Indianapolis. And we do not plan on stopping anytime soon for properties that are sub 100 units in markets that we like. So long and short of it, we're raising $4.8 million. This deal is about to be out of the inspection period. So we're pretty much finished with everything that we need to be comfortable with in order to keep moving forward. We have one large family office who will be our anchor investor in this deal. and will likely, usually they're 50% of the capital stack, so they'll probably speak for 2.4 million of it, and the remainder will be available on the terms that I'll show at the end. We've invested with that partner many times before, including in Indianapolis. Significant renovation cost here, so it's a big deal. Targeting 1.8x multiple invested capital, and as discussed, it's in a market that we really like. This is the building, the Harrison. It was built in 1935. So this was built pre D-Day, pre-Pearl Harbor. I mean, this thing is just like stood the test of time, has no structural issues whatsoever. It is built on steel and concrete slab. It is the most structurally sound property I think that we have viewed in the 10, 11 years that we have been viewing properties of this age. It has 0 floor inflection, which is in older homes or older properties when the floor bows or shifts or something like that. It doesn't happen. It's funny. I live in a condo in a newly built building. I think it was built in 2017. It has floor deflection. Almost all properties do. This one does not. It is like a bunker. It is in the near north side of Indianapolis. 84 units total. 24 of them, which are actually the beautiful units right on the corner of the building. It's 6 stories. So there's 24 of these units are really large format one beds. They're 650 plus square feet. They have those very large windows, and they have a pretty much 180-degree view in this historic neighborhood. So very pretty views. Those are staying as one beds. Then there are 60 studios that run the side of this property. Those we're actually converting into one beds. And to what Peggy and I were talking about at the beginning of the call, this is the way that we're really getting creative here. A, we're coming in to replace all of the MEPs, plumbing, electric, et cetera, which not all sponsors would be willing or able to do. And B, we are converting these studios into one beds, raising their rent potential by over 25%, which is what allows us to make this deal pencil and allowed us to win the bidding process. Named after Benjamin Harrison, 23rd President of the United States, and it has a large outdoor parking area. And you can see on this aerial map here, it's that long I-shaped building in a sea of other similarly shaped buildings. So we're in a very good position here because a lot of our local landlord competitors have done something similar, although not as nice a job as we're planning to do. And they also paid more for it at entry. So it's a little bit of a wash. So we've got really good comparables on doing similar projects with the same type of building, and good rent comparables that are 1-to-1 and all right in the same area. And B, we own a property that's 3 blocks from here. It's 38 units. And we did virtually the exact same thing, minus a couple of bells and whistles that we are going to add here, and are already exceeding what we've plotted for rents for this underwriting and property. So we feel very comfortable about the basis we're going in at. Indianapolis, high level, what I mentioned before is the most important thing. It's built up on life sciences, insurance, financial services, healthcare. There's a lot of university power there, including IU, which is technically a 40 minute drive away, but it's the nearest large city. It's in the MSA. So there's a lot of education aspect to it as well. Of course, there's a lot of government jobs there too, which are very sticky. And it's a massive logistics hub. I mean, that's why Indianapolis exists. It's the crossroads of America. It is where the first train repair stations were built in the US that were cross-brand. So you still see these massive train repair facilities that are still in use for Amtrak, very massive FedEx, UPS pieces, especially out by the airport. So it's a very large logistics hub, major Amazon hub for the Midwest. So very sticky, necessary stuff there. Life sciences, this is the home of Eli Lilly, which is the company that produces Mounjaro and will be producing Zepbound, which is the alternative to Ozempic. So this is a nice kind of next 20-year long component to this market. Eli Lilly is a Hoosier business in and out. That means Indianapolis local business. The CEOs of Hoosier. They do all of their manufacturing virtually in the greater Indianapolis area. And they really are the, potentially second place, maybe in the future first place producer of GLP weight loss drugs. So they're well positioned for the next 20 years and will be a continuing job producer for this city. More specifically, they're building a $10 billion massive manufacturing facility for Mounjaro and Zepbound right now. So it's just a really good job producer. It's a very livable, nice, affordable city. It fits the cookie cutter type of market that we're going after at Terra. And life is a little slower in the Midwest, but it's a very nice, pleasant experience. I'll be in Indianapolis. I'll be in Columbus tomorrow, and Indianapolis the day after. I grew up in Cleveland, so I'm allowed to say that Midwest life is a little slower. But this is a classic Midwestern, flat as could be, basically a prairie town. And rent growth's been really strong. The high supply constraint and people moving back into secondary cities, largely because of affordability, is a long-term trend that was accelerated by COVID and inflation. Indianapolis, Columbus, and Pittsburgh are all beneficiaries of that trend. So you'll see the population growth and the quality of population growth going up in these cities, and you'll see the supply of apartments being flat or lagging 5 to 10 years. And that is what we like to see in a market, and that's what produces rent growth. And that's been happening across our markets, but specifically in Indianapolis a lot in the last year. You can see that good rent growth. Overall market vacancy rate has been very low, and has just been going down ever since the 90s. Eli Lilly, this is the mock for their large manufacturing facility. I mean, this is a huge factory that they are producing, and it is in Lebanon, which is a 15-20-minute drive outside the center of Indianapolis. So Indianapolis city center. So major job producer for all the neighborhoods in the Indianapolis area and Carmel and Anderson, but it is especially good for the north side of Indianapolis because Lebanon is northwest of the city. This is where the property is. It's this star here. If you look towards the bottom of the screen, and I'm pointing, but obviously you guys can't see that. I don't know if you can see my cursor, but the center area here, this little green square, is that famous part of Indianapolis with the Soldier and Sailors Monument. And it's really tall. It's, if you watch Parks and Rec or any show about Indianapolis, you'll see that is this literal center of Indianapolis. Indianapolis is a planned city. It was actually designed by the apprentice of the architect that designed Washington, D.C. So the whole city is on a vertical and horizontal grid, especially the immediate downtown area. The stars where the property is, all this pink and IU Health is actually expanding. There's now more pink once those properties are finished all over the north side area because they're building a ton of new facilities there. But that is the IU Health, which is the biggest hospital system in Indiana. That is their HQ. So it is borderline walkable, probably 15-minute walk from our property, but it's an area where there are a lot of nurses and residents live in this area, which is a great target audience for us. It really fits the recession resilient long-term renter with strong income base that we're going for. It is also walkable and very close to Mass Ave, which is what's running up from the city center up to toward the northeast. That is the cultural bar strip city center fun area of Indianapolis. Every time we're there, we like to stay nearby. We go to dinner. That's where we go. Very nice place. And then the IUPUI health and education, nursing school, all that stuff is what you see here on the west side of town. So this is really on the inner, just outside the inner loop of Indianapolis, very much so still Indianapolis proper. And it's where a lot of the major employers are located. Everything downtown, the Salesforce Tower, everything like that is this would be perfect location to live in order to get to work there easily every day. The property that we own is, if you can see my cursor, it's right about here. But it's right in this area. That's the tenant base that we have there. So it's largely nurses, some residents, and then folks that work in their late 20s, early 30s, working business services jobs downtown. I won't get into the weeds on this set of numbers, but this is the high level of what we're looking at. 1.3x value multiple. So buying something for $100, it's going to be worth $130 when we're done with it, including all our renovation costs, et cetera, in that $100. 8.3% pro forma stabilized yield on cost, or stabilized cap rate, which is really strong for an 84 unit building that is so well located, but we're getting that high rate because we're being rewarded for the amount of work that we're doing and our creativity in turning studios into one beds. And yeah, that's the real takeaway from this slide. But you can see very healthy construction budget and hard costs here. It will be expensive for us to do what we need to do to this property, but we have done this many times and are confident in strong outcome here. Again, summary: 8.3% yield on cost, 1.8x LP multiple on invested capital, and 22% LP IRR. And I will stop going through all of the detail and the numbers. From a timing standpoint, we're closing at the end of September. Our plan is to have commitments in by the beginning of September, funding by mid-September. We will then renovate over the course of 24 months. There's currently really high occupancy in this building, even though it needs a lot of work. The elevators are slow. It's still 75% occupancy, which is shocking. We thought it would be much lower, just given the age and the last time anybody had done any work to it. And so we will do that over the course of 24 months. It will require us to cycle some of the existing tenant base out and move them to other parts of the building while we work on the parts that we need to work on. And then after month 25, we'll harvest. That is when the property is fully cash flowing and is ready to go. We'll do that for at least a year, and then we will exit at the end of year 3, likely in a brokered process. And we will do a national level search there for a buyer, just because it's such a well located asset. Usually we would sell to local groups or to a broker that we know has the connections of folks that are interested in investing in our target city. But in this particular case, this is just going to be a national blast, probably with a CBRE type group. I won't, in the interest of time, I won't get into all of the rent comps, but I do want to call out what we're looking at here. So the two circles here, one is the larger square foot, 1 bedroom on the corners of the building that I showed you, the beautiful windows. The second one, the smaller one, is the smaller studio that we're converting into 1 beds. These are the numbers that we have in our underwriting today that generated the returns we're talking about. For large format 1 beds, including ones that are slightly smaller than us, so the Turnverein, which is the craziest name, but is the actual name of this apartment building, which is slightly smaller than us, gets $1,385 per month for rent. For us, we're only saying $1,350. $1,390 and $1,390 for Meriden and Wyndham on Central and on Delaware, which are right next to our property and are direct comps for us. So we will be, anywhere from $35 to $50 less expensive than our direct comps. Then for the smaller format units, there's also one in Wyndham on Delaware, which is the same property as above, but $1,300, $1,340 is typical asking for those, and we're calling ours $1,250. Our property will be more recently renovated. It will have in-unit washer dryer. It will have refurbished elevators that are moving up and down quickly and not shutting down all the time versus some of these older properties. So ours will have a much better tenant experience. It will show a lot better. It will be brand new framing in the units, so it will just look like a new development. Also, because the property is so well built and has such little structural inflection, it will feel like new development, which we're very excited for. But point of this slide is just to say we're underwriting at lower rents than where our comps, slightly worse comps, are hitting, even though some of the comps on here have slightly higher square footage. So we feel very comfortable in where our rent comps are coming in. This is just examples of some of our comps. They're nice, but ours will be significantly nicer with a more modern, lighter feel. We wouldn't do something like this gray LVT here. We would do hardwoods. This actually is a beautiful property that had to do a lot of the same work to their windows and MEP systems that our property had to do. This is directly across the street from another property we own, so I see this all the time when I'm there. Significant value add budget. I mean, there's a total of $6 million going into this 84 unit property. It involves completely rerunning electric to every single unit. This is 1935 build. It has the original electric panel and socketry from 1935. So instead of having an electric panel with a fuse board, this has a small plastic flip up with 3 cylindrical fuse boxes, and when they pop, it doesn't, the electric panel doesn't have a shut off snap. They literally pop and smoke. I mean, it is a building from the 1935s, and it's the same electrical system. So we're updating all of that, obviously, so that we can accommodate in-unit washer dryer, so on and so forth. But it just desperately needs modernization. Also, the building does not receive sufficient amount of electrical service because it's the same electrical service as required for these 1930s fuse boxes. So we are upgrading the electric service with the electric company, which is a process we've gone through many times. It's easy process. It is a lot of hoops to go through, but they're on your side. They want to produce a higher electrical output for the property so they can sell more electricity to you, obviously. A similar thing is true with the plumbing. The current plumbing stacks are not in good shape. We're actually going to run new plumbing stacks from the basement up to the top floor, which will also allow us to change the layout of the studios. I don't think we have a before and after layout picture in this deck, although we really should. But we are taking what's currently laid out as a studio, rearranging it to be a very spacious, maximized, very close to 500 square foot 1-bedroom that will have a kitchen and bathroom on the same wall as the hallway, which is the modern standard for doing that, so that all the living space is farther away from the hallway. It'll be a very nice layout, but the new plumbing risers will make it very easy for us to do our tie-ins at the unit level and accommodate that new layout. Just on the right-hand side here, these are some random examples of before and afters from properties that we've done, but this on the right-hand side is what our property is going to look like once we're finished. It will be stainless steel appliances, large format white subway tile backsplash, large format white subway tile in the bathroom, new vanity, new mirror. Probably in this case, it will have brand new shower and bath tubs because we're getting rid of the old ones. So it will look very nice, all white cabinetry. It will be engineered hardwood flooring. So really top of the line that fits allows us to be ahead of our comparables and our competitors, and allows us to market directly to the high paid nurses and residents and business services folks that live in this neighborhood. We're also replacing the old windows in kind with the historic district. So we've already got approval for that in place and our vendor selected. And those are the major components of what we're doing. We're also repairing the old elevator system, which is in remarkably good shape and with the right new parts and repairs. Doesn't require any type of retrofitting or replacement. So got lucky there. And so we will come away with a very nice product. But a lot of these things, the electric, the plumbing, et cetera, are very expensive components of these projects. And again, ones that we do all the time, but are kind of sit on the cusp between renovation and really redevelopment of an old building. And this is the investment terms overview. It's pretty typical from what we normally do. If you guys have looked at our deals before, 7.5% pref, 1.75% AM fee, 8% construction management fee, 1.5% acquisition fee. So pretty much market or slightly below market on our fees. And then we do a 20% carried interest structure over the 7.5% hurdle. So once we've hit that hurdle, we split our profits 80-20 instead of 95-5. We will be 5% of the equity in this deal, and the remainder will be third-party capital. So I will stop there. I think there's a couple things that I'm happy to chat about on why we like the Midwest, more about why we like Indianapolis or this submarket in particular. But our entire thesis is really predicated on working in this geography. And I would just end quickly with this slide that is our three target markets: Pittsburgh, Columbus, and Indianapolis, versus the U.S. housing market through the 2007-2008 financial crisis. Certainly our markets did not thrive, but you can see we're slightly down or pretty much flat. Indianapolis pretty much just flatlined through it, whereas the rest of the U.S. had a huge buildup and then a crash. So that's kind of how we see these markets. They are going to be a little less newsworthy and explosive on the upswing, but then they will be significantly less catastrophic, and you'll be happy how boring these markets are on the downswing. And depending on who we're talking to, we're either in a soft landing or recessionary environment over the next few years. So we think it's always smart to plan a recessionary resilient investment strategy, but right now it's probably especially smart to do so. And so we are very thankful that we have been focused on that for so long. But I will stop there, and any questions, please fire away.
Well, I have a plethora of questions, so if anybody else has any questions, raise your hand so I can see it and we'll call on you. Eugene, you look like you might have a question. No. Oh, you are very thorough, Ray. But I still have questions, no matter how thorough you are, because I just want all these little things to ask.
I know I couldn't get away scot-free from you, Peggy. You always have good questions.
Oh, good. That's good to hear that they're good questions. Yeah, so I was just curious if this is one of yours that is in your fund, or are you doing this as a one-off? This is in your fund.
That's actually a very good question. This one is not in our fund.
Okay.
Our Fund 1 and Fund 2 were both for sub 20 unit properties. Our Fund 2 we've passed the point that we need to raise to close. We still have a little bit of space left over, if anybody's interested in discussing that, but is virtually raised and is about 2/3 deployed.
Okay.
Our Fund 3 will be 50 units and below. But for the foreseeable future, properties that are between 50 and 100 units will remain one-off syndications like this deal. And that is for a number of reasons, but the main one is that the returns profile for 50 units and above versus 50 units and below is just very different. So, and also the things that you need to do. So a lot of this MEP replacement and elevator work and larger capital projects like that, where we get up into the 50-60% of our total development cost is in hard costs, so stuff that we're actually doing to the building, that is more common above 50 units and is a different risk profile and a different set of returns. Our returns here are strong, but our returns in the fund are 500 bips higher on IRR, are 0.3x higher on multiple on invested capital, and are significantly lower construction risk. The risk is hedged out a lot to many different smaller properties. So there's pros and cons to fund investing with us versus investing in an individual asset, but 50 below, 15 above is where we will be cutting off in the future for our fund. And where this is an 8.3% stabilized yield on cost, which is very strong and rewards the amount of work that we're doing, Our fund is 9.25. So almost 100 bips different on stabilized yield on cost.
Okay, great. Well, that was great information. And on that, I just wanted to point out to everyone that the last one that they put together, the rehab on it was 16,300 a unit, and this is 90,000. So understand that this is a way big rehab, huge rehab, particularly when you're in 6 floors and you're replacing, oh my God, plumbing and electric. Which brings up, are these all individually metered so that they're all paying their own water, gas, electric?
They are not, but they will be once we're done. So we will stay with a single water meter. Our markets, it's actually very common to charge back tenants $35, $50 per person per unit per month for water alone. So for the most part, water is either a wash, so to speak, on cost, or it is a slight profit center for our properties. But right now, there is one, if you can believe it, for all 84 units and common area, there's one single electric meter, which
Oh, no, I
is
believe it.
insane.
Is that
But
aluminum?
yeah,
Is
everything
that
about it is.
aluminum? Is the electric aluminum right now?
It is, and it has knob and tube and all that good stuff. So it's got to go. But
No.
once we're done, everything will be separately metered. And we're not 100% sure, but we will likely switch to all electric for in-unit appliances. So we will not use gas stove. We'll use electric.
Oh, boo. Do you cook?
I do. I prefer gas.
Exactly. That's
But
the point.
it does make for a much more efficient building in the end. And it weirdly is a selling point for these smaller unit non-family style builds because folks actually don't like the idea of gas, and they're usually not cookers. When we have properties with 2-3 beds units, it becomes much more important, weirdly enough. But we've seen it both ways.
It's okay. I order out most of the time anyway, which probably a lot of working people also do.
There
Eugene.
you go.
I've got one business question and then one non-business question. What's the backup plan if you're not able to find a buyer in 3 years?
Yeah. So, and you mean the buyer at the end of our
Yes.
hold to sell?
Yes.
So one of the things, we're a yield first entity. I mean, in fact, we thought about incorporating the term yield first into our firm's name. Because we are focused on the IRR and the MOIC and all those things, but where we are laser focused is that we want to get that high stabilized yield on cost stabilized cap rate at entry. So what here is 8.3%. That's what we're focused on because we know that if that's high enough, then the spread between that and where we can sell is what will drive our returns ultimately. And so we want to get higher yields as much as we can. So that is important to us for returns purposes and how we generally philosophically think about real estate. One of the benefits of that is that if you're stuck with a property you can't sell, it will be a cash cow. So if you have an 8.3% stabilized yield on cost, at the end of year 5, that will have materialized into closer to a 9% or higher just with rent growth in this market. I mean, that's conservative. It actually would be much higher because rent growth has been high single digits, but that will get close to a 9% with debt at let's call it 6.25, 6.5%, or maybe even lower at that time. Then you are cash flowing nicely up into the low to mid teens for a property that recently renovated / redeveloped. That's super strong cash flow. So the downside scenario would be to hold it if we couldn't find a good exit timing, hold it and cash flow it. But really, I would not be super concerned about exit in this particular case just because it's so well located and is a nicely sized property. A 35 unit property in the same location would have a little bit more question of whether or not that it's easy for them to sell. But in this case, I have very, very high conviction in our ability to exit. But yeah, the worst case scenario, owning a long-term cash cow, worse things have happened.
And your other
Okay,
question?
my non-business questions. I'm thinking about coming to Indianapolis. And now I have a reason to visit. I want to see Caitlin Clark play. Can you get me tickets?
I potentially could. Caitlin Clark tickets are exclusive to our investors, Eugene.
Okay.
No, actually, but we're good friends with one of our brokers is the son of one of the Pacers GMs. And so we actually get tickets to stuff in Indy all the time. So seriously, let me know if the timing works out. We might actually be there, but I haven't seen her play and I would love to.
There's an excuse. All right. Good ask. I want to interject. I want to ask about that loan before we go to David. So are you what kind of loan are you in now?
Yeah. So
Will it be
what we will,
assumable at the year 3?
yes. So we are going to enter with a bridge loan to finance construction here.
Okay.
We do that with Bancorp, not the bad New York Bancorp, the boring Midwest Bancorp that has very attractive rates. So our last one was 8.6%. The 10-year was higher when we did that. So it could be lower, which actually is not that far away from some of the stabilized financing that we've seen over the last year. So very good pricing. They will fund a lot of our renovation costs, which allows us to keep equity very efficient. But for a number of reasons, it'd be difficult to finance this property with traditional long-term stabilized financing and entry. The occupancy is very good for a property of this age with the amount of deferred maintenance it has, but it is still sub 85%, which is usually a trigger point. So it'd be very difficult for us to figure out a way to kind of circle that square. And two, because of the required MEP enhancements, it would just be difficult to get a long-term stabilized lender in here. So, long-winded way of saying, we'll enter with the 8.25% to 8.5% interest rate bridge loan after our 24-month period over which we're renovating units and filling them in and starting to cash flow, which will allow us to pay a lot of that debt service because it's interest only. We will refinance into a long-term stabilized loan, which I would expect to be at that time, to be fully honest, I would expect that to be a high 5%, low 6% interest rate, given where the market seems to be moving. But if we did it today, it would probably be 6.75%.
Okay, great. Thank you for that. David?
Yeah, hey Peggy. I had a question. I kind of came in late with the on this opportunity. I don't know if your company is also investing in the property as well. That's one of my questions.
Yes, we are. So we will be 5% of the total equity here.
So you're investing 5%?
Yes.
Okay, of the purchase price, right?
Of the total development cost. So, or rather, not of the total development cost, of the total equity required. So equity here is 4.8 million. So we will be 300 some thousand.
Okay. And you mentioned the comparable income in the area.
Yes.
So is there comparable sizes? This is 43,680 square feet total interior square feet, correct?
Yes.
So the average, or I don't know, are they all about 500 square feet, 520 square feet?
Yeah, they run the gamut. This is probably our best set of comps. There's actually have been some more recent ones that were a little bit. I don't know if you can see the screen or not, but it kind of ranges anywhere from the larger format ones, kind of like 550 to 800 square feet, and the smaller formats anywhere from 425 to 550 square feet. And so that's, our comp set is some bigger, some smaller, some slightly nicer, some slightly less nice. But we will be the large format will be kind of middle of the road on size, but the nicest, and the smaller format will be towards the small end of the range on size, but by far the nicest, including in-unit washer dryer, which is rare for the smaller format one beds.
Yeah.
So are you saying there's larger units than the 520 square feet?
Yes. Yes. So our large one beds, which are 24 of the 84, are 675 square feet, and our smaller ones are 460 square feet. So there's 450 square feet ones in our comps. And then there's one very large one, which is 800 square feet. Rent in the Midwest in general, but specifically in Indianapolis, is less per square foot and more just on the unit size. But we think it's important to differentiate between a smaller one bed and a larger one bed at the very least. But we generally don't pay as close attention to rent per square foot, because that's just not how the market reacts. Like you can see this here is a 580 square foot that rents for $1,385, and then 800 square foot. That's 26% larger and only gets $6 more per month. So it's not a perfect correlation.
Yeah, well, based on those numbers, if you have a larger unit, based on per square footage pricing, that's going to be an issue. I don't know how the market is there, but I know certain markets are actually slowing, or not decreasing. Harder to find tenants at this point, but I don't know about that market. But I won't throw that out there.
No. It is an important point. And for our larger one beds, our size is fine. I'm not worried about that. For our smaller one beds, we are not the smallest, but we're probably the second from smallest. And so we still have strong comps, but we're compensating in two ways. One, we're putting more work into this property than our competitors have. And two, we're underwriting lower rents than even some of the smaller ones. Like there's a smaller 450 square foot one in here that's $1,340 per month, and we're underwriting to $1,250, and we're an extra square foot or so. So we're compensating by both of those ways to de-risk the fact that the studio to one bed conversions are smaller. One quick anecdote on rentals. That is very true across the US right now. Rental inbound interest volume and rents have been going down. It's very regional. So our markets rents have been, versus last summer, up maybe 3 or 4%. And the demand has been pretty much the same. So it's looked like a normal year after kind of a gangbusters 2023 and 2022. There are other parts of the US where that is not true. And that's largely due to overbuilding and too much supply in the market post-COVID, and for projects that started in 2019. So you're 100% right about that trend. It has been 2024 has not been as crazy as 2023 and 2022 for our markets, that we're seeing high single digit, low double digit rent growth. But it has been slightly up, more like a normal year would be, somewhere between 3 and 5% year over year rent growth.
Does that answer your question, David?
Yes, thank you.
Okay, Paul's asking a question. You did go over this, so he was taking a nap at this time. How long have you been, and I know you went over this with you and Tom and your time together since college, etc. But he's asking, how long have you been working with the GC for this job, and what is their track record with your company? And you were talking about the project manager, right?
Yeah, no, I did not cover this, and that's a great question.
Fine.
So this is Artizone, which, if you have familiarity with stuff in this part of the Midwest, they're actually fairly well known. They are a great firm. We have worked with them 2 other times before. They are super professional, and frankly, I wish we didn't need them, but this is a big project, so we are going to use them. So they will oversee all the MEP replacements. They will do the electric and the plumbing work in-house. Where we're doing this in other properties with fewer units and simpler build, we would manage that process ourselves. We're not going to do that here. But this is a very well-respected company. They've done right by us in the past, which is not usually what I would be my feedback on GCs. Sometimes they're fantastic, but very frequently there's tension after a project. I would say these guys are very Midwest honest, and they do what they say they're going to do. So we're excited to have them on. Normally, again, we would GC this ourselves, but not the case here.
My apologies, Paul. He was listening.
Very closely.
I have to be straight about that and, call it like it is. Yeah. So got me on that one, Paul. Yes, Ted.
What do you expect to be the demographics of your occupancy?
Yes, we are very specifically targeting nurses and residents here. So I would like the occupancy of this building to be above 50% hospital staff. This is right next to the nurse and resident training center for IUPUI in Indianapolis rather, and it is right next to the Indiana IU Health HQ. They're expanding like crazy. So a bunch of new vertical specific buildings that are going in right in this neighborhood. One is literally 2 blocks away. That is for oncology and a children's hospital. So they're specific verticals, but will be well staffed. So that's what our main focus is. We would like to have mostly that. I would say the remainder will be folks that are working the medium cost location business services jobs downtown. So Salesforce is actually weirdly one of the largest employers in Indianapolis. Everything that happens at a technology company that is not SEXY and would be in Silicon Valley, it happens in a place like this. And so these folks don't get laid off in a recession. They're super necessary. They're nuts and bolts people. They're maybe not the highest flying, coolest computer programmer jobs in America, but they're well paid and they're sticky. And so those would probably make up the remaining, 20%. And then I'm sure we have a grab bag for what's left over after that. Otherwise, though, I would expect this to be a fairly diverse crowd. These are folks that come to Indianapolis from around the state and from around the Midwest for healthcare and tech and business services jobs. So these are going to be, not all local lifetime Hoosiers, but folks from all around the Midwest. And then I would say probably not many folks over the age of 35 and not many folks under the age of 27 will live here. So
I have one quick question because we're going to top of the hour. And did you have to go through any historic anything in this building?
Heaps. So this is everything in this neighborhood is an historically nothing is historically protected. Everything is in historical jurisdiction. So the historical review board has to be consulted for anything that happens to the exterior, but nothing to the interior. All the windows are being replaced because they're very old and desperately need it. That is a huge undertaking with historic. So luckily, there's a pre-approved plan to replace them. So we know the vendor, we know the cost, we know that it will be fully approved again when we go through, and we've confirmed that with the board. So we're not worried about that, but it's a thing. And it's not going to be the easiest process, and we probably won't pop out a window and replace it for at least 4 months, maybe longer, depending on the season.
So one last question, Paul and I both have it, and that's you have 84 units and 45 parking spots.
We have an easement with the current owner for an open spot lot that they own in the middle of this complex. Actually, here, that's this, if you can see my cursor, this lot is an open lot that is unspoken for. This lot here is for this building. This lot here is for our building. This is an auxiliary lot for the properties around. The seller owns or owned the vast majority of the properties in this little area. So we'll use that for overflow, but there's tons of parking on Delaware and street parking in this area. It's actually kind of a negative to our business case. We would love to charge more for parking, but there's a lot of free parking nearby. So
Thank you. And that's good. Ted, did I cut you off?
The follow-up that I was going to have is, it sounds like you're expecting a relatively high fraction of single females. Do you have any safety or security considerations here?
Yeah, there will be. So this building already is a double door entrance building. So it has an antechamber. So it has two layers of entry for each entry point. There's only two, so they're super well lit already. We'll actually add lighting to that. And then we'll add what is it's called Butterfly, but it's the least expensive, most effective version of this. We use it at the property nearby, but it is the face recognition at entry. So when somebody rings, it's not just a buzzer like an old building would be. It actually shows you who they are, like a Ring doorbell. So we'll install that, and it'll be much safer. We do not have plans for any additional external security or security personnel here. This is a very nice neighborhood. It is a low crime area, but it is an important point, and we're thinking about security for sure because of that. This would pretty much all be singles. Very few couples live in smaller format one beds. The larger format one beds maybe. But yeah, you're very right. It's mostly for nurses and residents that are, younger, single, living alone.
And there are a lot of men that are nurses now, so that'll be a nice mix too.
Yes.
Yes.
Very true.
So we are at the top of the hour, and I thank everyone for all their questions and attending today. It's been really a remarkable presentation. You're so very thorough, Ray, and I really, really appreciate it. And I hope you will come back again. And I will, when you get that to me, I'll get over it, and then I'll send that out to everyone.
Excellent. Thank you, Peggy. Thanks for everyone else. I really appreciate the time. If you have more questions, whatever the process is, was through Peggy or directly to me, I'm more than happy to discuss in more detail, and would love to have some folks join in on this one. We do a syndication like this probably once every 3 months, every 4 months. That probably sounds right to you, Peggy. So if it's not this one, it'll be the next one, but it's great to get folks involved early on. And then hopefully we can introduce you to the fund and some of the other projects that we work on. But we have a very long runway and pipeline for multifamily properties in the Midwest. So we'd love to have you.
Thank you. See you next time.
Cheers. Thanks all.